Hello everyone, this is Avicharya and Rohan Singh recording our Charts Are Fun weekly session for the week of September 2nd. I was on vacation last week, recording it now on a Sunday, September 8th. Wow, did the market have a tumble? Everyone's extremely worried about the Fed's interest rate cuts, about the economy. This idea of a soft landing, which people had taken almost for surety, is now a bit of a concern. We know that very recently Fed published the Bureau of Labor Statistics actually published the downward revision on the jobs data for the entire year from April of 2023 till end of March of 2024. Almost over 700,000 jobs were downward revised. Turned out the employment data for August came out on Friday. Didn't quite get what the market was thinking. 114,000 was the initial report for July. That was downward revised to 89,000 jobs that were added, not as what the market wanted. So yes, there is a deterioration in the job market. Unemployment slightly ticked lower from 4.3, came in at 4.2, but there is an upward trend. The worry is that the jobs is getting impacted. Powell himself at Jackson Hole has indicated that he is kind of won the battle on inflation, but he is concerned about the job because his mandate is a dual mandate. He has to control price, keep price stability, but also full employment. He has to look at how the employment overall is doing for the economy. So that is a concern. So any slowdown in the economy, market is now anxiously and patiently waiting on weekly jobless claims to get an indication. It's a high frequency data, not as relevant in many cases, but now it is relevant. Now market is really eyeing, is it going to be a 25 basis point cut or a 50? There's a cut for sure. Powell has indicated that. He has indicated that this time has come for a policy change, which means there's a sure shot rate change for sure. Likely a 25 basis point. We'll look at what the CME FedWatch Tool is telling us. It did has fluctuate around for the last several days as economic data comes out. At some point, in fact, on August 5th, when the Japanese stock market crashed, we got the 50 basis point probability in the CME FedWatch Tool go up as high as almost 85 or 90%. Since then, it's flipped. As of now, I'll show you where the CME FedWatch Tool lies. It's about 37% or so chance of a 50 basis point cut and a 63% of a 25. Fed has to be cautious in how they do these rate cuts. If they suddenly aggressively cut 50 basis, market may take this as a negative indication of the economy slowing down. Market may not like it. Market may get more worried about recession. And as you know, market tends to price things out ahead of the actual event. And that could mean that the continued sell-off that we saw this week, the first week of September, could continue into the next several weeks. There's election uncertainty. There is the concern about the recession coming up. And, the kind of a week we got, boy, was the sell-off deep and sell-off harsh on specific sectors. Technology sector, XLK, got hit over 7.5% down this week. NASDAQ QQQ, that is the NASDAQ 100 ETF, was down over 5.5%, literally 5.8%. Small caps, IWM, also interest rate sensitive, was down 5.5%. S&P was down 4.1%. Dow Jones, the DIA, the Diamond ETF for the Dow Jones Industrial ETF Index, that was down 2.5, so that slightly did better. But across the board, NVIDIA was 14% down. So let's quickly look at the charts, just some long-term charts this time only. I'm going to keep this video short. Look at the monthly chart of S&P 500 and NVIDIA and try to get a gauge of where we think the potential downside could be. So let's share the charts. So our Charts Are Fun Substack site is chartsarefun.substack.com. We do publish daily blogs. We appreciate you subscribing to it. You just put your email and you can subscribe to our blog. Our YouTube channel is at Charts Are Fun. We publish weekly videos. This is going to go out on this channel shortly after I've finished my recording. And we appreciate if you like button, if you hit the like button, if you like the videos, and also subscribe to our channel. We really, really appreciate that. So I talked about the FedWatch tool. We talked about the August jobs data coming out on Friday. Market didn't quite like the fact that there was a downward revision on the July data. From 114,000 jobs, it was revised down to 89,000. Expectation was for 165,000 jobs to be added for August. We didn't quite get it. We got something in the order of 142,000 or so jobs for August. So market is worried about the rate cut expectations, and on the probability tool, we can see 63% probability is what the market is putting as of now for a 25 basis point cut. We can see here that's the now, 63 for 25, 37 for the 50. A day ago, before that job data came out, it was at 70-30, right? So it did come down slightly. The market had a higher chance of a 25 basis point cut. Now it's thinking that maybe the 7% higher probability of a 50 basis point cut. A month ago, early August, 8th August, in fact, as you can see, it was flipped. 50 basis point was 55%, 45. But that was a couple of days after the market recovered from the August 5th crash. This is August 8th. But on August 5th, when the market was crashing and tanking, the Japanese market tanked huge, it was actually completely on the much, like over 85, 90% was a 50 basis point cut expectation. Let's look at S&P 500's long-term view and look at in the past when we've had the yield curve uninvert. Right now we know we've had a inverted yield curve. Why? Because we can see that if we take the 10-year treasury and subtract the 2-year treasury yield from it, the 10-year minus the 2-year, that was in a negative territory for most of 2022. It kind of dipped first part of 2022, first quarter of 2022, was negative for most of 2022 through 23, and into 24, the first half of 24, it was all negative. Just recently, as treasury market yields have tanked, especially the short-term treasury market yields, 1 year, 2 years have tanked with expectations of a rate cut, because Fed has now clearly indicated they're pivoting, they're going to start cutting. It has converted to positive. The uninversion has begun. It's at 0.06. It's slightly positive, but in the past, when yield curves have gone from negative to uninversion and back positive again, look at the S&P 500, which is right above the yield curve inversion chart. Look at what ends up happening. You get a drop. So back in 2007, when the uninversion happened, we get a drop in the market. An inversion happened in 2000, late 2000, a drop in the market. In 1990, we also had an uninversion where that yield curve uninverted from 0 all the way up to as high as almost closer towards the 2.5% level, or little between 2 to 2.5% level. There, when that uninversion happened, S&P actually went up after the initial dip. Yes, there was a dip. So, right, the vertical lines are indicating when the uninversion, as in from a negative yield, it went to positive yield, the 10-year minus the 2-year. Right there was a correction from 361 to 304 was the S&P 500 correction. But since then, it has absolutely gone on a ballistic climb. Now, this is during a secular bull market, 1980 to 2000, a 20-year secular bull market. If you listen to Tom Bowley, you listen to others who look at economic cycles and secular bull versus bear markets, they talk about a typical secular bull market of a 20-year duration and a secular bear market of anywhere from 12 to 13 years. So 2000 was when the last secular bear market started, to 2013. And from 2013, the next secular bull market has begun for 20 years, up to 2033 is the expectation. So if you're in a secular bull market, the indication and probability is that though we may, as the yield curve uninverts and starts going positive, we might be more like towards the 90s. But initially, we may get a hiccup, and we've already seen that pullback start. 56.48 to 54.08 is where S&P is right now. So there is a possibility that as the yield curve uninverts over the next few months and it starts going higher, we could get a pullback in S&P 500, but could it be something as deep as in the secular bear market phases in 2000 and in 2007, or is it 2007, 2008, or is it more like the 1990s? Tom Bowley and others feel it's more like the 1990s. Small correction would come, and then from there, as the market averts or avoids a recession, a soft landing is beautifully arranged, mastered by the Fed, Powell and his team. The market would continue going higher. There is the secular technology trend that we know everyone strongly believes in. This is a massive secular trend on AI. Productivity, innovation is driving the markets higher, especially the US markets. Technology companies like NVIDIA are absolutely controlling the next generation of how technology will be consumed and used by not just the consumers, but the enterprises and the businesses and so on. So OpenAI is on the software end doing those innovations, while NVIDIA is on the hardware end. And of course, you can't rule out AMD, you can't rule out others out there that are like Palantir and others that are kind of driving the AI innovation, but you could expect this AI innovation to be here for at least another decade, if not longer. And so innovations on electric vehicles, right? We see that autonomous driving. We see innovations going on in quantum computing, innovations going on in space. There's huge opportunities for mankind to be kind of really creating that 21st century experience that we've seen only in movies like the Back to the Future kind of experience. So that's something to look at. And the other thing I also want to point out on the top of the chart is the unemployment rate. Unemployment rate has typically, as the yield curve has uninverted and started steepening, unemployment rates have in all the three instances started creeping higher. So in here, we notice that unemployment went higher. In the 2000 to 2002 timeframe, unemployment went higher and then started coming down. Same thing happened in the 2007. This one, by the way, I'm not talking much about it during the COVID times. That unemployment spiked higher, absolutely, no question. People were sitting at home. There were many jobs that were impacted. But then it very rapidly came down as we recovered from COVID with the great miraculous vaccines and the world come back to its normal. In this particular case, unemployment is begun to, of course, trend higher. We can see that in early 2023, we had unemployment in the 3.4%. From there, it's come up to 4.3. The last sprint was 4.2, but this could just be a temporary 1-month hiccup, and then the unemployment continues going higher. So that's another worry, that when unemployment ticks higher, market comes down. Unemployment ticks higher, market comes down. So something for us to look at. Unemployment going higher is something that Fed would be worried about, and that ticking higher would mean more cuts coming in. And in some ways, maybe those cuts could help the small caps, could help the interest rate sensitive sectors. Now I'm going to quickly look at S&P 500's long-term chart. This is the monthly chart of S&P 500. Every candle represents a month of trading. And what we do see here is right now we have, as S&P has gone to higher highs back in 2018, every couple of years we get some form of a bear market pullback. So 2872 to 2346, we got that bear market pullback in 2018. So RSI was extremely overbought and pulled back to the 50 level, and then again started rallying up towards the 70, back towards the 50, zigzag between the 50 to the 70 or 75, 80 level. But at three successive peaks, from the 2872 to 4818 to now the most recent peak near 5669, we definitely see a weakening RSI, lower highs, much higher RSI here in 2018, weaker RSI in 2021, and now in the 2024 timeframe, RSI has pulled back to the 64 from right just a little above 70 at a much lower high than from the 2021 and the 2018. That's something a bit of a concern. We can notice that PPO has begun to curve lower. So PPO kind of had a hump in the early part of 2024, pulled back slightly, another hump, but now the PPO histogram has begun to curve lower. We've already got a 4.25% pullback just within a week. And the candle percent potentially, if it starts trending lower for the remaining few weeks in September, how low could S&P pull back? Well, in the past, you notice as it has kind of gone higher, it has pulled back quite every few years and tested that rising 20-month moving average, and that's around 49.03. We know that our recent August 5th low, was at 41.19. So, 51.19. So from 51.19 on the upper end to the 4900, anywhere in that region, that's what Tom Bowley talked about, is he's expecting a correction to continue, S&P to somewhere bottom out in between the 4903, the 20-month moving average, to the 51.19 level of the August 5th low. Usually, that we can see here, the 51.19, it could test that, and then from there maybe kind of have a whoosh, kind of a move lower to test the 20-month and then maybe rebound. Another possibility that cannot be ruled out is we've kind of got a double top at 56.69, with the M-shaped double top with the bottom at 51.19. That's about, if you add this up, 500 points from 51.19. That 500 points takes it to 46.19, which is from where we broke out from the 2023 high around 4600. So that's a possibility that worst case, if this is an M-shaped double top, then we could go back and retest that 2023 high near 4600 and from there resume a climb. So those are the two targets to keep in mind. One is a potential test of the rising 20-month moving average at 49.03. If that gets more bearish and further setback, for whatever reason, bad data is not going to be treated as bad by the market. If there's further bad economic data, their Fed has no other choice but to cut rates. But then as they're cutting the rates, market gets nervous, thinking that something bad's happening with the economy. Maybe the soft landing isn't going to happen. That kind of nervousness, election jitters is also there. Any kind of regime change, any kind of possibilities of the Senate and the Congress, which party will control it and so on, could cause shakiness in the market and perhaps a deeper pullback. From there, I'm going to talk about the king of AI, NVIDIA. In the news, there have been bulls pounding the table. Dan Ives, by far, has been the biggest bull of the AI. He's been constantly calling NVIDIA as in the first innings of their massive AI bull run. He calls him the godfather of AI, Jensen Huang, the CEO, and he has recently been in Asia. He's talking about his spot checks on the supply and the demand situation there, and he feels that demand far outstrips supply from NVIDIA's AI chips. He's extremely bullish. He feels that this is a buying opportunity. And Dan Niles, the other Dan, who also has been very, very bullish on NVIDIA, kind of pointed that yes, in the near term, there is going to be a correction, a buying opportunity perhaps. He himself is starting to raise cash, but then he sees NVIDIA's revenue double and the stock double from here. So we're talking about 104, 105 level where NVIDIA is, could double to 200 plus, and the revenue is currently at just about 100 billion annual. That could easily go, double of that. Dan Ives is actually even more bullish. He feels that the way NVIDIA's AI insatiable demand will be across enterprises by governments. He has in fact said people compared to Cisco, but who were the customers of Cisco? Those were the dot-com companies, which really didn't have any revenue, nor did they have any balance sheets. Today, in the AI-driven economy, in the AI-driven bull run that we're having, who are the buyers of NVIDIA's chips? It's those top trillion plus market cap, mega cap, cloud providers, the mega, call it the hyperscalers, the Microsofts, the Google, the Alphabet, the Amazon. They're buying these. They're buying the spending like billions into tens of billions of AI spending on NVIDIA's chips. And he feels that governments are buying AI like chips like no tomorrow, building out their kinds of smarter countries, smarter AI-led innovations in their respective supply chains of countries. So he feels that NVIDIA has got huge potential. He feels that at some point NVIDIA could be generating revenue of 100 billion plus every quarter, forget for the year. So that's where he sees the upside for NVIDIA. In fact, his thoughts are he wouldn't be surprised to see NVIDIA cross the 10 trillion market cap in the next decade. With that, if you look at NVIDIA's chart, we know that it had a massive drop this month so far. In the first week of September, 13.86. The telltale sign of this pullback was after NVIDIA's earnings, which was the week before. Even though the earnings were strong, even though they beat revenue and the earnings, the stock did not act well. It came down 5%. So with NVIDIA not acting so well after earnings, and now if you look at how it has started from its PPO declining, we can see that the PPO's histogram is at a lower high. We can see that the black line is about to dip or bearishly cross below the red line. We can see that RSI has dipped below 70. This is again a long-term monthly chart of NVIDIA. So that's at 69. And the other key thing to look at, which is Tom Bowley has very rightfully pointed out, is look at how overbought and how extreme NVIDIA's bullishness has been. Rate of change over the 24-month period, which is a 2-year rate of change, crossed that level from 2018. At that time, NVIDIA had crossed the 740 level. Today, it's at 747%. So that's, just think about it, right? It's got 8.5 times the stock has multiplied in a span of 2 years, right? So that's kind of unsustainable as far as Tom Bowley is concerned. He saw that and he said, once you get to those levels, you get some digestions, you get some pullback. So you got that pullback. Same thing, pullback happened in 2021. Didn't go up as to 750%, went up to over 500% pullback. That kind of a pullback comes in NVIDIA, where some of these PPO crosses over, some of these signs, you can see the relative performance to S&P didn't just recently top out. It topped out from the June timeframe and has started kind of moving lower. So where can NVIDIA go down to? Well, one level that one needs to watch on is we can retest the August low at 90 for sure. But potentially, if this kind of rate of change at 750 being that extreme, pulling back down, we could expect this to break below the August low. And one point of test could be its rising 20-month moving average in red, and that's at 75 bucks. So 75 could be a level of support that NVIDIA could be testing. However, you cannot rule out a potential possibility. In the last couple of times when rate of change was that extreme and it pulled back all the way down to its 50-month moving average in blue to test that level. So here, that 50-month moving average is actually closer to 37. So if you do a measured target from 90.69 to 140.75, so that's a subtracted level of 50, subtract 50 from 90.69, you're talking about 40.7, which is not too far from the 50-month moving average. So worst case, NVIDIA could be headed towards the 40 level. Tom Bowley, however, is expecting that this level, which is the peak of the 2023 high around 50, could be a strong support where NVIDIA could potentially, in the worst case, pull back to. There's a good chance we see 70s in the next few weeks, next couple of months, and maybe that would be a good point to start nibbling some on NVIDIA for those that don't have a long position, but potentially getting an opportunity to buy NVIDIA at 50 or lower would be one heck of an opportunity to play the AI bull run to continue for the next several years. With that, good luck investing this week. We do have CPI data coming up on Wednesday, PPI on Thursday. It's going to be both market moving. CPI in particular is going to be market moving. And then the Fed comes in to talk about interest rates and their decision the following week, the following Wednesday. So we're talking about 11th, the CPI on Wednesday, and 18th, the Fed decision at 2 o'clock. That, good luck investing. Talk to you all next week. Thank you.